Most people in America statistically are following one of the two S's. You're spending all of your money or you're saving all of your money. Let's start with the first S, spending all of your money. Somewhere between 55 to 75% of Americans, depending on which study you read, are living paycheck to paycheck on a flat broke, meaning you make money, then you spend all of your money on your rent and your groceries and your car, and then you have no money left over to go on a vacation, to save any money, or to invest. Well, at the same time, we got a new study in 2025, which says that a little bit over 70% of Americans own a Netflix subscription. Now, I am not the best math nerd out there, but if you do some basic math, what this tells me is that most Americans are spending more money on their Netflix subscription than they are on their investments. And I want to see that flipped. I would rather you invest more money than you spend on Netflix, but of course I'm not the king of the world, but that's the first problem, is that we prioritize the wrong things. We want to have this comfort and freedom and this release. I get it. Look, work is hard. Trust me, I get that. But if you don't have any investments, if you don't have any savings, if you're drowning in credit card debt, how can you comfortably sit there at night knowing that your family is relying on you and you have no money in case anything were to go wrong, let alone having any freedom for your family? I want you to reframe the way that you think. Secondly, it's you save all of your money. Now, I grew up in a traditional Indian household, and in the traditional Indian household, it is a save-heavy culture. I made a joke that Americans make $1 to spend $2, Indians make $1 to spend 20 cents. And what you do now is you work to make a big salary because you become a doctor or an attorney or an engineer, and then you don't spend anything. Well, the problem with that is your savings are slowly losing value to inflation. If the average savings account is 0.5%, and inflation is 3%, that means your savings are losing about 2.5% of their spending power every single year. So if you have $100 in the savings account, you just lost $2.50 of buying power by saving the $100. If you have $1 million in your savings account, you just lost $25,000 of buying power through this risk-free investment, which is keeping your money in the bank. Now, there's a time and place to save, but saving all of your money is not how you become wealthy. The way that you become wealthy is by investing your money. Mistake number 2 is the casino effect. Warren Buffett says that more and more investors are treating the stock market like a casino. Robinhood has added gamification into their app, so you celebrate buying, you celebrate trading, which can turn your investing into more flipping. Not to mention the fact that slow compounded growth of your money doesn't sound very attractive because the average market return has been 10% a year, which if you ask anybody on the internet sounds so boring and dry because Bitcoin has been averaging 100% a year. In fact, maybe a little bit more than that. So why would you want to try to get this 10% return when you could get 100% return a year? Well, let's just do some math. The best investor in the history of time is Warren Buffett, and he is now one of the wealthiest people in the world. He's a multi-billionaire. Well, his average return, because the way he built his wealth is by investing his money, his average return has been around 19% a year. Now, yeah, that's a lot more than the market average, but it's not 100% returns a year, but he's been able to become one of the wealthiest people in the world by compounding 19% returns a year. So this is where it can be very attractive to fall into how do we get these types of returns, but statistically, these types of returns are high risk, high potential reward. And chances are you're going to lose money, especially over the long term. Or maybe you're not going to see the returns that you want. Now, I'm not saying crypto is a bad thing. I'm not saying you shouldn't buy Bitcoin. What I'm saying is you got to understand the risk and reward nature and the volatility that comes with more speculative assets. Because the way that I invest my money, and I can't recommend what I do to anybody else, is I want to be diversified against bad things happening, because we know the market crashes happen. We've seen 16 recessions over the last 100 years. We've seen 25 market crashes over the last 100 years, and chances are we're going to continue seeing more in the future. And when those crashes happen, the speculative assets fall even further than the non-speculative assets. And this is where I invest my money into my own business, Briefs Media. I invest my money into real estate. I invest my money into stocks. I invest my money into speculative assets, which include things like cryptocurrency, includes things like startups. And then I own some physical gold. Gold makes up about 2% of my portfolio. But the speculative assets, the speculative part of my portfolio, make up about 18% of my total portfolio. And the only reason why it's 18% is because I have built more wealth through my stocks and real estate. I know I've been very fortunate to be able to do that, but that's why I've now expanded my speculative part of my portfolio because, well, it's more risky, but I also know that if my speculative investments went all the way down to zero, I would be completely fine. And so when you're starting out, understand that speculative investments can make you a lot of money, but they can lose you that money just as fast. And so if you want to invest in them, fine, but just make sure that they fit in your portfolio as a speculative piece of your portfolio. Now, listen, I'm not a financial advisor. I'm just a random guy on YouTube. I can't tell you what to do with your money. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But history doesn't exactly repeat itself, but it does rhyme. And this is where it is very valuable to take a look at history and understand what the possibilities are. That way you can position yourself in a way to actually win and build wealth, as opposed to just trying to gamble your way, maybe flipping your way, trading your way, and trying to find the next hot meme stock, the next hot meme coin as a way to build all of your wealth. Some people will do it, most people will not. Mistake number 3 is missing the big market moves. Now, I also want to remind you that if you are an investor or want to become an investor, my team and I have put together a brand new free investing masterclass where I'll walk you through how my team and I look for investment opportunities before they hit the mainstream, before they hit the crowd. I'll show you the same system that my firm uses to find and research investment opportunities. It's a completely free masterclass. And when you register for the masterclass, you also get market briefs, my investing newsletter for investors, as a complimentary bonus. So if you want to get my investing masterclass and market briefs all for free, all you have to do is click the link down in the description below to register and get it all. Warren Buffett has a saying that time in the market beats time in the market. And what that means is nobody can predict when the next market crash is going to happen. We know the market crashes will happen, but we don't know if it's going to happen tomorrow or next week, next year, or next decade. We also don't know when the bottom is going to be. We also don't know when the top is going to be. And a lot of people want to perfectly time the markets. But instead of trying to time the market, just keep letting your money compound in the market. Just keep buying the markets every week or every 2 weeks or every month. Because if you do that, if you just let your money sit in the market instead of trying to time the market, chances are you're going to win. And let me just show you some data from Bank of America to back this up. Bank of America looked at the impact of missing the market's best and worst days of each decade between 1930 to 2020. And what we can see is that over these 9 decades, markets grew by 17,000%. Now, if you were a great investor and you did not have your money in the markets on the 10 worst days per decade, you would see a return of 3.7 million%, which means, yeah, you got really rich. But what if you were a little bit wrong? If you exclude the 10 best days per decade over these 90 years, you would have only gotten a 28% return on your money. So if you just kept your money in the market instead of trying to time the market, well, then you would have seen the 17,000% return. Mistake number 4 is investing on emotion. Markets go up and markets go down. We have seen this trend happen for decades and it's going to continue to happen. And the same thing happens in each one of these downturns. People panic, they sell, and some people become incredibly wealthy. For example, in 2022, we saw the stock market, more specifically the S&P 500, fall by around 20%. In 2020, we saw the S&P 500 fall by around 34%. In 2008, during the financial crisis when the real estate market crashed, we saw the stock market fall by around 57%. And then during the 2000 dot-com bubble bursting, we saw the stock market, again the S&P 500, fall by around 50%. By the way, the S&P 500 is just a basket of stocks that looks at the 500 largest companies in the stock market. So what have we seen through history, at least in the last couple decades or so? We have seen markets go up and we've seen markets go down. Over the long term, we have seen markets go up. Markets are a lot higher today despite all these recessions, despite all these market crashes. And in each one of these downturns, what we saw is that people panicked and they sold. I like to call it poop. P-O-O-P. Panic leads to overselling, leads to opportunity, leads to profits for those that are long-term investors. And in each one of these downturns, we saw poop happen. Poop happened in 2022. People panicked and sold. Some people got very rich. In 2020, poop happened. Some people panicked and sold. Some people found the opportunity and profited. In 2008, poop happened. People panicked and oversold, which created opportunity for profit. In 2000, poop happened. People panicked and oversold, which created opportunity and profit. Why am I saying this? Because if you are a long-term investor, you don't want to get caught up with the emotion. You want to understand that, hey, these things happen and they're going to continue to happen. And if you're going to make any changes, well, assuming you hold on to good investments, not things that are on the verge of bankruptcy, this can create opportunity for you to come in and buy at a discounted price, because recessions and market crashes create more millionaires than any other time, because they allow savvy investors to come in and buy good investments at a discounted price. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.